Welcome everybody. We're at the Best Ever Conference, and this is the #Apartments podcast. We're really just having a conversation here with Zach Haptonstall with Rise48. I'm Joe Renderconnect with Upgrade Partners Capital, and one of the best deals to date that we have invested in has been with Zach and your team, Rise48. Now, we're talking today because a lot has changed in the world around multifamily, interest rates, inflation, the election. There's a lot of uncertainty, right? And so what I want to talk to you about, Zach, is what has changed and what are you guys doing specifically to hedge risk, to keep cash flow distributions moving forward for investors? You guys haven't done any capital calls, so let's talk about the macro perspective of what's changed and what you guys are doing to mitigate risk. And talk about why is now the best time for an investor to jump in?
Yeah, no, absolutely, Joe. Yeah, so like a lot of people know, interest rates really started to skyrocket just over 24 months ago, right? March of 2022. And in commercial real estate, especially multifamily, when interest rates go up, values go down, right? So now in the short term, values are down because of interest rates. And so, I always tell investors, it's like, think of it like the stock market. You want to buy low, sell high, right? We haven't sold a deal since July of 2022. And I've told investors we're probably not going to sell a deal until maybe second half of 25 or 2026 at the earliest, because I don't want to sell right now and give a discount to a potential buyer because of where values are at. But we do think now is a great time to buy deals. Now, last year, 2023, you had the fewest amount of multifamily transactions since the Great Recession, okay, the GFC, okay? You're on the heels of 08, 09. That's because groups that don't have to sell are not selling. And so we think now is a good time to buy because we can get deals at a really good basis, right? A lot of these deals that we've bought in the last 18 months, the net operating income and the rents are actually higher than they were 2 years ago, but we're able to buy them at a price per unit or a basis that is at least 20 to 30% lower than it was 2 years ago, right? So it kind of reminds me, Joe, like in 2020, okay, about 4 years ago, during COVID, March of 2020 hits, everybody's freaking out, we're freaking out, what's gonna happen? We don't know if these deals will perform. By July, we're like, everything is going well, there's no issues. So we quietly started to tie up deals off market second half of 2020, when everybody thought we were dumb, like, what are you doing, there's COVID, freak out. And there was no competition, right? We've already sold all 5 of those deals, they were home runs for investors. And I'm not saying this will be the exact same, we don't know how this will play out. So maybe not apples to apples, but it just feels like the last 12 to 18 months, the private equity firms have been on the sidelines because of interest rate uncertainty. Yeah. A lot of the retail syndicator groups or private capital groups really can't raise money, so they haven't really been buying. And we've been finding selectively really good opportunities, from distressed sellers who have interest rate caps expiring that they can't extend out. They have balloon payments coming up, and we've been buying deals at significant discounts. And we think now is the best time to buy because there's very little competition. We're getting significant discounts from where deals are at. And these are deals that we feel confident we can execute the plan and increase the NOI and get good returns for investors. Now, at the time of this recording, we're doing this like middle of April. Just this week, Blackstone announced that they just completed a $10 billion acquisition of a REIT, right? Now, the last 6 months, I've talked to a lot of private equity guys, and they're like, the private equity industry is very herd mentality, right? Everybody kind of just follows the herd. And people have been saying at conferences I've been to, it's going to take some big movement. People have literally said, it's going to take like Blackstone making a big movement. They just made the big movement this week at the time of this recording. And last week, the president of Blackstone came out and said he thinks that we are at the bottom of the values, right? He doesn't think it's going to get much lower. And so what does that tell you? And I think personally in the last 2 weeks, I've talked to several top brokers in Dallas and Phoenix. And I'm always asked that, where do you see it? Where do you see it? Are the PE companies, the private equity companies coming back? In the last couple of weeks, Phoenix brokers and Dallas brokers have told me that demand is coming back. They said there's not a lot of deals to buy right now on the sales side, but buyers are starting to come out, start to see it. So I think the next 6 months, you're going to start to see competition come back. We still have a good window here. We can buy deals at a good discount, execute the business plan. So to answer your question about how do we adjust, basically, it's important to take lower leverage loans, raise more cash reserves, have more liquidity, and make sure you can actually execute these business plans, and that's what we've been able to do. And so we feel really confident, the deals we bought in 2023, they're all performing really well, cash flow positive, distributing to investors every month, and performing. And so we feel like this is a good window of time because there's just not a lot of competition, and that competition we're out of.
Yeah. Well, we certainly appreciate that, having the cash flow distributions. And I think the fact that you guys got in back in 2020 shows your, reputation and your ability to stay one step ahead of the market and get in even when there was, blood in the streets, right? So you got in, things have gone really well, and so you can kind of repeat that cycle, right? The question is, Blackstone saying we're kind of at the bottom. A lot of these lenders, as you've talked about, have been working with the syndicators, the sponsors, right? Like, how much longer do you think they'll be able to continue pushing out before they're just like cut off and there's an enormous amount of foreclosures or short sales,
Yeah, it's a good question. I mean, it's really just going to depend on, how much liquidity do the borrowers have, right? And the majority of the owners and the borrowers are large private equity firms that have a ton of liquidity. So they've been just pumping money, extending these things out. So, some of the distressed deals are, they're capitalized with retail base. Maybe they don't have the capital or they didn't execute the plan to be able to extend out. And so I think, the second half of this year, you'll probably start to see, selectively. I mean, and what do I know? Maybe there will be this widespread distress, but everybody I've talked to, they've already expected it in the last 6 months and it hasn't happened. Okay. And so I think it will be selective. I personally don't see a huge wave coming of distressed assets just because these groups are well capitalized, extending them out, but there will be these selective opportunities. Yeah. And right now there's very few buyers. Okay. So the sellers and the brokers, when they are distressed, they're not taking these deals to market because they don't want to announce this, right? They want as little publicity as possible. And so, some of these deals, sellers will come to us directly because they have a relationship with them. They don't even blast it at all. Okay, they're not taking it to the market. Brokers are bringing us deals because we've been able to execute and close on them. And so it'll be interesting to see, but that's kind of where our perspective is.
Nice. Now, one last question is, we've talked about the deals, kind of your business plan now. From what I've seen is there's a ton of dry powder out there, right? People are sitting on the sidelines trying to figure out the uncertainty, calculating as best they can. Like, what would you tell an investor outside of what you said already, or maybe you can confirm a little bit of what you said, how do they feel comfortable investing with you now, even with that uncertainty, right? Because there's got to be some level of trust, a little level of comfort that and you guys have an amazing track record, right? And for us at UPC, we only work with the best. And so here we are with the best, right? So what would you tell, investors that are on the sidelines? They're like, should I not? How do we make them feel comfortable with getting in right now?
Yeah, no, I mean, as an investor, you need to do your own due diligence, right? And you need to determine if you're comfortable. And if you're not, you should not invest, right? But if I'm a passive investor, you want to be looking at the operator. What is their track record? And the biggest thing is, how are you structuring the debt, right? What are you doing to mitigate against the interest rate exposure, right? And so you have to look at the debt structure. You have to look at has the operator traditionally been able to execute a business plan, for sure, right? So there's a lot of things you need to look at. But I mean, from our perspective, we feel confident that we're mitigating the risk with the debt and that we are able to execute these plans. Yeah. So we think now's a good time to buy. But obviously, it's always there's the cliche quote that everybody posts on social media from Warren Buffett, right, where he says, be fearful, everybody's greedy, and be greedy when everybody's fearful, right? Everybody's fearful. So Warren Buffett says when everybody's fearful, now is when you're supposed to attack and you're supposed to get the opportunities. Well, the funny thing is a bunch of people like to post that and say it and they don't actually do it, right? We feel like now is where the opportunities are, and we're thinking for ourselves. We're going off of the data and the facts and the performance of the portfolio and saying, yes, now it makes sense, right? We think now is a better time to buy than any time in the last 24, 36 months. And so that's just our take. But as an investor, you need to do your own due diligence, your own comfort level, and really, make sure that you're grilling these deals to make sure you feel comfortable with it.
Yep, for sure. Last thing I'll note too is one of our biggest criteria too is that the sponsors that we work with are vertically integrated. They have property management, construction. They have a team to support them, right? If you're a 2-3 man team and somebody gets sick or somebody gets hurt, the deal's dead, right? But you have an entire team, you're vertically integrated, and so you have this entire support to make sure that you can focus on what you're best at, which is going and getting deals, making sure that the team is performing, so that's one thing that we really appreciate about you guys. And we look forward to doing more deals with Zach. Got a couple coming down the pipeline. So if you want to learn more about Zach, reach out to us. We would love to make an introduction to Zach and the deals that we're doing. Remember, I'll just stand up and show. Back of my shirt says every day I'm cash flowing. So that's our focus, we focus on cash flow, preserving wealth, and helping you get into real estate. So thank you, Zach.
Thanks so much, Joe.
Appreciate it.
Thank you, man. Appreciate it.
Woo!
Well,